candlesticks in swing trading. And what I like to do is first go through a bit of the definition of what is a swing trade, what's a swing, and then I'll follow that up and really dive a little bit deeper into the different candlesticks and how I use them in conjunction with swing trading. Essentially, all coming down to really what my focus is really high probability swing trades, and I find that candlesticks to sort of give you sort of a quick preview really give me that additional edge. I am affiliated over at marketfi.com. I'll talk about that later, where I have a swing trading trading alert product. Okay, so let's get going on this. Move on to the slides. The art of swing trading, it's a higher probability strategy. And what we're first going to go through in terms of the definition of swing trading, what is why swing trading, then identifying a swing, right? Otherwise, if we can't identify a swing, it's a little difficult to really make sense of it all. Then we're going to look at spotting a turnaround point. And really what it all comes down to is what I focus on, so-called high probability price confluence zones. And last but not least, certainly we have to look at setting targets and stops. Important to note, swing trading, just like many different things in the trading world, and you just heard from John, we all have different styles, and so also the definitions of certain terms we tend to use are a little bit our own. And in this case, I think I'm pretty close to what the standard definition of swing trading is, but I'm just quickly giving a heads up. This is my definition and how I use it. Just like it is for the strategy, this is my swing trading strategy. There are tons of swing trading strategies out there. So let's first get into the why. Why swing trading? A lot of people start out trading, retail folks, and they first have to sort of find their own rhythm. What is their time frame? Is it day trading? Is it longer term, fundamental research type of stuff? Or is it something that's a little bit more in the middle? What I've found is that for most folks that start and have more of a trading mindset, swing trading really fills that gap. It's no stress, so it's not too quick. It's not a lot of intraday futures back and forth. And it's certainly not boring either. So it's a really good sweet spot. A lot of people have a job on the side. So this really is like a good middle of the road strategy that allows you to look at the market, maybe once a couple times a day at most, and still have a very high probability strategy. Also, sort of as a side note, trading is a business. It's not entertainment, and swing trading really, the way I do it, and by the indicators I use, they're very clear to use. There's no crazy voodoo behind it, and it really makes it easier for folks to treat it as a business as opposed to just entertainment. The comfortable time frame of a swing trade is sort of what I alluded to before. It's not too stressy. It's not boring. Somewhere between 2 days and about 4 weeks tends to be the average swing trade. Why the 2-day time frame? Sometimes things just hit a target or get stopped out very quickly. It happens in every to everyone, so that's why I have the definition of 2 days. But most of the trades are probably at least a few days long to 1 or 2 weeks or something like that. Another point about swing trading is that it really is not something that day traders focus on. The time frame is clearly too long. It's more than 1 day by definition, and it's also too short for a lot of institutional investors. So you're really in a pretty good spot where a lot of opportunities come up, but they're not very crowded. So you tend not to get chopped around as much as you would say in if you're a really hectic S&P futures trader. At the same time, there are a lot of setups every month, and it's pretty steady. Obviously some months there are more than others, but more or less there are almost always setups. Even in the slow periods like in August, and the second half of December, there are setups to be had. And I would say best of all, really what swing trading is all about is all about using defined stops and targets, and especially, and I'll talk about this later when I look at candlesticks, when I set up a trade, to me, it's very important that I have a clearly defined stop and, if possible, a profit target, and swing trading really allows you to do that. Okay, so let's talk about identifying a swing. Um, to me, a swing has has a duration of anywhere from, like I said, a couple days to several weeks in terms of my trading. There are, of course, swings that last a lot longer. But essentially, a swing is when you start making either a lower high or a higher low. And a lot of times, and you'll see this in the following few slides, I'm already kind of jumping ahead. A lot of times it's hindsight. So it's kind of stupid to think of swing trading that where you'd be able to see the swing before it happens. Obviously, you can't do that, but it's important to understand where in the broader picture you are, so that you understand where the next swing might be coming from. And you can see here's a chart of F5 Networks, which is a great swing trading stocks, by the way. I'll have an example on it later, where it just really offers great swing trading opportunities, and the extremes, the extremities of each swing are pretty clearly defined. And again, we'll look at that in just a minute. Like I just said, they're simple to spot, the swings, but they're mostly in hindsight. So also the different time frames I just talked about. What's important about swing trading really is that you stay within your time frame. And you can essentially keep a swing trade on as long as you keep making to the long side higher highs for months, just like John talked about in his squeeze trade. So if that's your time frame, you also have to really be able to understand that you need to give your stops and your targets just a lot more patience, right? To me, my definition is 2 days to 4 weeks. I find that to be the sweet spot after more than 13, maybe you think it's almost 14 years of trading this professionally. I feel that that's a really good sweet spot. Also, again, it's not too boring, it's not too hectic. It fits most folks quite well, so that there's enough activity to do, enough stuff to check on, but not too much. Okay, let's also quickly look at a swing on Apple. Okay, and this kind of summarizes what I've just said in maybe one or two too many words. On Apple, and this chart is a little dated. Obviously, I think Apple punked out somewhere near 430 or 420 the other day. But Apple, of course, had a big swing down starting in October, and that's, if you want to look at it from a long-term point of view, that's the primary swing. That's not necessarily a swing I personally want to make use of, although sometimes it happens that we can do that as well. You just have to then use weekly charts. But within this swing, we had several smaller swings. You can see that we had a swing off the November lows, off the December highs, and again from December up, and then finally lower into the lows here in early February. So that's really what I'm talking about when I talk about swings that last from anywhere between, at the very least, 2 days to about 4 weeks. Spotting turnaround points is really what I try to focus on when it comes to using all my so-called confluence zones. If you can spot a turnaround point more or less consistently, and that's what I try to do when I look for my high probability trades, you will be successful with this strategy, no doubt. I'll look at these confluence zones here in a second, but at the end of the day, what I look for is for certain areas on a chart where you have multiple things come together. Moving averages, support lines, Fibonacci retracement, momentum things, and certainly candlestick formations. And again, we'll look at those in just a few minutes when I get to the candlestick part of the presentation. if we look at a high probability confluence zone, not only do we end up having great entry points, but we also immediately define our risk. And we'll look at charts in just a second. The more technicals come together at any given confluence zone, the higher the probability of trade will work out. The stop usually will be on the other side of the confluence zone. I'll show you that in the chart. My objective when I swing trade is not to capture the entire move, but I want to capture at least the first few percent. On average, I try to go for at least 3 to 4, hopefully 5%. Of course, if there's runners, that just keep on working, one can certainly keep a partial position on for as much as 100% for all I care. Exactly, Tom. Nibble from the middle. In fact, in this case, and a lot of people say, try not to capture, try not to try to pinpoint lows or highs. It's actually kind of what I try to do, but I have a lot of confirmation when I do that, and it automatically defines my risk. Yeah, and William, you're right. It's certainly you get a higher probability of winners, and also very important, it keeps you in the game. It keeps you active. Okay, if you stay in a trade forever, you have so much time to think about that trade and so many times to change your mind. And we humans, we're emotional creatures. So it's important to be able to everything I do in swing trading and all the stuff we'll look at here in just a second, it's all to basically battle my emotions as a human that come in and try to little people on my shoulders that try to tell me to talk me out of the position or into a position. So let's see, what did I talk about? Keep an position. Yeah, no need for greed. That's another good point. There's plenty of opportunities. Okay, that's what I said before. This strategy in swing trading, it's not intraday, but it's also not too long, but it still offers a lot of opportunities. Okay, there's no reason to chase anything. Let's go through some examples finally. Let me quickly get out of this and into the examples of a swing trade. Okay, I'm actually gonna make this a little bit larger, and do let me know if you cannot see this well enough. Ming, we're gonna look at confluence zones right now. I'll define. I'll give that the definition right now. That's really the point of the charts here. Okay. So let's look at F5 networks. And David, my typical gain is I try to reach somewhere around 3, 4, most likely 5%. Okay, but it's repetitive. Okay, this goes on. There's constantly trades. But let's look at confluence zones. Okay, that's really the key point here. So this chart, I hope it's not there's not too many things on it, but it's actually quite simple. There's 3 lines. I use a 200-day simple moving average. I use a 100-day moving average and a 50. Okay, very, very simple and straightforward. However, that's not the only thing I use. Okay, if we look at F5 networks, started selling off here in May of last year, and bottomed out, and finally in November bumped into its 200-day moving average for the first time in since May that year. At the same time, it also had retraced from this move, from this swing down, and that's the definition of a swing. We started making higher lows, right? But from this swing down, it retraced almost exactly 50%. Okay, so that's point number 2. We bumped into a moving average, and we retraced 50%. Next thing, and we're going to look at candlesticks right now. I'm going to zoom in a little bit closer, and we actually had a shooting star candlestick, more or less, okay? A lot of people will say that's not a technical shooting star. Yes, you have to be a little lenient on these things, okay? And we'll look at candlesticks in a minute. But that's what we had. We had a confluence zone of 3 different things coming together. Also, we had overbought momentum, okay? Which I don't have painted on here, but I use stochastics and RSI. Also, very simple stuff, but I use them in conjunction, okay? And Ming, I hope this answers your question about, what's what's a confluence zone. It's when all these things come together. And it doesn't have to be the 200-day moving. It could have been the 50-day moving average. The point is you look for areas where multiple things come together. Rosa, the 200-day moving average is red. In this case, that's the only thing that really matters. Then the blue one is 100-day, and the 50-day is in yellow. But it doesn't matter in this case. The point really is just it's just this. There's a few too many things on this chart, and I'm going to make it easier for you later on when we look at candlesticks. But for confluence zones, it's important to note several things. Let's look at another example. Let's look at Yum Brands. I use slow stochastics, Warren. Why? I just find the normal stochastic is just a little bit too hectic. Let's look at Yum Brands, and let's look at the example we had. I need to see now what I marked here. Right. Okay. Look at Yum Brands here in November 2011. Okay. What we had happening, we had the stock starting to form a resistance point, resistance line that started in July of 2011 and started getting tested, which actually was the definition of this trend line in November 2011. By the time we moved, I'm going to go in very close here. By the time we moved into this trend line, we then retraced, and I'm going to draw this in for you quickly. Okay, we retraced 38.2%. Okay, that's an important Fibonacci number. At the same time, we moved into support of the 200-day, the 50, and the 100-day moving average. Okay, that's huge. So that's two things right there. We retraced an important Fibonacci, and we retraced right back down to these moving averages. Momentum 2 was oversold, and very important, and this is again we'll look at in just a minute. We had a very good candlestick. We had essentially had a kicker signal where the stock just jumped and moved higher the following day. Okay, these are all what I consider part of a confluence zone. Winston, if you want to talk about slow and normal stochastics, it's probably an off-topic thing, but these are standard things you can use and think. Like I'm using Thinkorswim here for the purpose of this presentation today. But these are basic things you can use, and you can look those up on the internet anywhere. It's just using different moving averages. Okay, let's look at one more. Oh, stop loss. Martin, we'll talk about this when we look at candlesticks in just a minute, but the stop loss is always at the bottom of the signaling candlestick. In this case, it would have been right below, right at about 52, 52.40, 52.50 to be greedy. Okay, we'll talk about that in a second. Two more examples. I'm going to talk about Crocs now. Okay, Crocs, by the way, a good trading stock. Okay, let's look at Crocs in early last year. We had the stock, and it's a volatile one, sell off big time here in 2011. Ultimately, it found a bottom. Yes, I'm using daily charts, Michael, certainly. Started selling off and started moving into the 200-day moving average for the first time in months. Okay. At the same time, we moved into the 200, and we had a Fibonacci retracement. I can move that in as well. Draw that in as well, which was a little bit above 50%, so between 50 and 61.8%. We also had overbought stochastics, and guess what? There was a signaling candlestick in here. And again, we'll look at those in just a minute. So that's one more example. Let's look at FDS. Last example of confluence zone, and I hope you're starting to get the idea behind how this works. It's all about multiple signals lining up. The stock I just looked, Sheila, the stock I looked at was Crocs. Now we're looking at the FactSet. FDS is the ticker. Let's look at FactSet. This one is a little bit different. This has a few different indicators. I'm going to use one off the bottom here There was support, simple lateral support, and believe it or not, those that actually do tend to work. Look at this lateral support we had somewhere between 86 and 87 or so, spanned over a long period of time, a little more than a year. We retested it again in November of just last year, oversold, and had a huge outside day. Okay, and we'll look at these candles in just a minute, like I keep saying. Rob, I know the colors are tough to read. We're going to have a white background in the charts in just a minute. Okay, this is the last chart with the gray background. I'm sorry about that, folks. But we had an outside day, and that was a signal, and you go. Again, another confluence zone. Okay, so I hope this made sense. In terms of setting stops, let me quickly bring up this presentation again so you can see it. There's a couple of questions coming up, and we'll look at that when we look at the candlesticks in just a second now. Profit targets are, in my mind, somewhere between 5 and 10%. They can be quicker. It depends on the situation. Okay, I say maximum here with, there's certainly exceptions to this. I think there's plenty of trades you can just let run, but I always want to take some off at 5% and maybe a little bit more at 10%. That's just my strategy. Again, I want to take part of the swing, not the entire swing. Steady and conservative wins the game. And I think this is probably the most important thing that I can pass on to anyone. Trading is not about being greedy and being nervous and getting overly anxious about everything. It's all about understanding that your performance should be measured over the period of about a year or so. But within that year, there will be tons of trades, and any given trade can go wrong. But any given trade has a much higher likelihood of going right, at least in my strategy. So then it's just a numbers game, okay? And that plays into the psychology of trading, which, by the way, I'm holding a webinar in that this coming Tuesday at 4:30 p.m. Eastern. If you're interested, maybe you can shoot Morgan a message, or you can shoot me a message at Serge at thestudytrader.com, SERGE at thestudytrader.com. Okay, now let's get out of this and let's look at the candlesticks and how I really use them. And I'm going to try to be not very much longer, probably another 15 minutes, because this topic doesn't take that much long to look at, but it's unbelievably important. Okay, let me just get to the candlestick webinar presentation, and here we go. So now I hope everyone's understood my general confluence zone I look for. It's now time to look. It's now time to look at the candlesticks. Okay. What are candlesticks? We're going to quickly go through the definition of candlesticks. Why use candlesticks, right? I mean, the answer is obviously because they work. I'm going to look at then the 3 highest probability formations that I know, and again, I use them in conjunction with that confluence zone I just discussed. Okay. I hope this makes sense. And of course, last but not least, we'll look at candlesticks and how they really help me define stops and also targets. The other important note here is that candlesticks sticks and formations are today's topic, but again, there's many ways of using these. It's just that this is my own way of using it, so don't think this is any sort of the only way to use these. Let me ask just a quick question from Jake. Your thoughts on using an ATR as a swing? I do use ATR as swing, but I use it more for intraday. Okay, quite frankly, I haven't really been a big fan of using it on a longer term on the swing trades, but I guess that would be my answer. I do a lot of S&P futures trading intraday, where I have a totally different strategy. How do you scan for these stocks? I have certain scanners set up on various platforms. I use anything from Bloomberg to Thinkorswim to just proprietary stuff I have. But I usually scan for about 4 to 5 different types of setups. But the 3 highest probability ones I'm going to look at right now. Okay, what are candlesticks? Candlesticks is really nothing else than displaying price action in any time frame, intraday, daily, weekly, monthly, in a different and quite frankly in a much more powerful way. They're similar to bar charts, but like I just said, they're just much more powerful. It all originated from the Japanese rice traders. I think it's like they started using this in the 18th century, so this stuff really works. Um, the other thing about candlesticks, and that's, you'll see this as we look through the examples, they're extremely visual to spot, so they're clearly obvious to see. To give an example of this, if you look at the right two charts on the right hand side, we have a candlestick chart, and you don't have to look at the details here. We're going to look at those details in just a second. But just generally speaking, there is a lot more you can read technically out of this chart over here on the right than what you can read out of this bar chart on the left. Okay, that's just a very simple fact. In terms of what a candlestick looks like, there's essentially two types. There's ones that open lower, that open and close higher, and others that close higher, that close below the opening print. Okay, and of course there's ones that where you have an unchanged day, and those are called doji. But on average, you have if on these charts, on my charts, you'll see that they're in red and in. Actually, let me just move over to that correct setup here. 1 second, so you can see this. So you can see these charts. Okay, so here's an example quickly. In my examples, the candles that had a higher close than where they opened are green, and candles that have a lower close than where they opened are red. Okay, and that's essentially what these look like. So in this case, in the first example, you have an open here and a close here. How about the stuff on the peripheries here? What are these? These are so-called. Some of them call them legs. Some of them call them. What else do they call them? 1,000 different things. Yeah, wicks. Tails. Whatever. So it's not volume. What you have is essentially that's a trading range for the day. Okay. So this stock, whatever this is, had a trading range all the way up here, all the way down here. But it opened here and it closed here, and you'll see in a minute how powerful this information is. The candlestick over here is the other way around. It opened here and it closed here, but the intraday trading range was essentially much larger. Okay, I hope this makes sense. Now, why use candlesticks? Again, I just talked about how much more powerful they are simply from a visual point of view. But the other thing is, what the price action of a candlestick really depicts is not only price action, but also investor sentiment and footprints that you otherwise don't see. In other words, candlesticks also show you the emotions that investors have at any given point. Like I just said, footprints that can otherwise only be difficult. So instead of looking at a gazillion different indicators, one candlestick, if it's powerful enough, can essentially tell you almost everything you need to know. Okay. But again, if you use that in conjunction with these confluence zones where other technicals come in, your probabilities of a trade working are even higher. And that's what I really do. So the formations are key. There's a lot of formations that happen with candlesticks. You can have things happen. You can have individual candlesticks that give you a very clear signal, but you can also have formations of, say, 2, 3, or even 4 different candlesticks that tell you something very, very powerful. Again, making the entire process very visual. Decision making is essentially without emotions. If you see XYZ candlestick that you know should give you X and Y signal, then you just have a trade. It's very simple. There's no emotions, and that's really what the retail trader needs to as a help, is to keep the emotions out of the game. At the same time, there's defined risk by very clear stops, and we'll look at those in just a second. Okay, so here they are, the three high probability formations that I really focus on. First one's a shooting star. We'll look at those in order. Then the hammer, and then the outside days or engulfing candles. And again, I use all of these in conjunction with these confluence zones. The hammer really is a candlestick that forms at the bottom of a swing, and I'll show you examples here in a second. forms at the bottom of a swing, and it leaves a long tail or a long wick, okay, in a small body. Essentially what it tells you is that sellers have given up, okay? Let's look at an example. Let's look at, I can show you Under Armour. I guess I'll show you both examples. It doesn't matter. Okay. Let's look at Under Armour. In fact, just a few days ago, we had well, not a few days ago, but sort of mid to late January. Look at the hammer that came in here on the 24th of January. The stock had been trending down for quite a while. Okay, we had a downswing, swing going down, making lower lows. Okay, and also lower highs. And ultimately, on big volume, might I add, the stock opened a little bit lower, but really tried to push quite a bit lower intraday. Eventually, when it all was said and done, they just absolutely failed to keep the price down there, and hence you have this long tail. People, will get very technical on this, but at the end of the day, a hammer, all these candlesticks I'm going to talk about, as long as they more or less look like the formation that it should have, in this case, at the bottom of a trend, a very long tail and a small body, it should qualify as the correct candlestick. But again, of course, the difference in my situation is that I really try to use these in conjunction with confluence zones. And look at that. There was a support level, very important, in fact, a multi-year support level, and resistance and support where the stock came to, and it gave us this huge hammer, a blind buying signal in my book. Okay, the following day, the stock gapped up and had a very nice rally intraday to close higher. So very, very powerful stuff, and the stock now, of course, is trading higher. John, what time frame? These are daily charts. Okay, swing trading really is in the way I use it really best done using daily time frames. Hence our targets of on the very bottom and 2 days to as much as 4 weeks or so. Yeah, and exactly, daily takes out the noise again. But again, William, it really depends on your time frame. Like again, I trade a lot of S&P futures intraday, so relative to the time frame you use, there really isn't that much noise. But of course, if you swing trade with these time frames that I use, daily charts certainly do take out the emotions. Yeah, each candle is 1 day, Jay. Next example, let me see what I had up here to show you. Next example is Apple. Let's look at Apple. Everyone should be perking up in their seat right now to look at an example of Apple. But Apple has a lot of these formations, and hence, to me, makes it a great trading stock. So look at Apple with a very nice support level around 525. Again, this is nothing crazy. This is very simple stuff. On November 25th, on November 16th, when, by the way, last year, when also the broader market bottomed, the stock had a huge hammer on very big volume, much above average, and the following day, the stock gapped up and rallied, okay? So the confirmation is important in the hammer signal, where the hammer you don't want to buy blindly, you want to wait for a confirmation up day. In this case, you would have bought up here. Now, the stock moved another almost 5%. I would have been happy after 3-4% here at the most, because the longer term, the Apple was still in a downtrend that it wouldn't have been able to reverse so quickly. But this is a very good example, and is one that I traded. So that's the hammer. Let's see, what else did I want to talk about on the hammer? Was another example. Yeah, I guess the point was really when I use hammers as candlesticks, not only do I need to see them at confluence zones like I just discussed, but I do need to see a follow-through buying day. Okay, I need to see a follow-through buying day. That buying day doesn't have to come on the next day. It can come in any of the next, say, 4 or 5 days, but at some point I need to see confirmation. It's not so in a shooting star candle, and we'll look at a shooting star candle in just a minute. Okay, now next example is engulfing candles. Let me get back to the presentation. Engulfing candle. Okay, an engulfing candle can happen both at the bottom or at the top of a swing, and it'll define as long as there's follow through buying or selling. It should define the tip or the bottom of a new swing. So this is what they look like at the bottom of a trend if you have a bullish engulfing. So you can see we had a downtrend coming into this stock, whatever it was, and the following day the stock opened lower and closed higher. It fully engulfed this entire trading day's market action. Okay, to me, this is one signal that also you don't necessarily you need follow through buying on one of the next few days for it to be valid. At the top end, however, if you get a bearish engulfing signal at the top where you have a move up and all of a sudden you get one day where you open up a little bit higher, then you have a nasty reversal intraday and you close lower on the day and fully engulf the previous day's body, okay? Not the entire trading range, although that's even more powerful if it does, but the body. And then you don't need confirmation to go short. Now that's my rules for this kind of stuff. Next chart, examples. So I'm going to look at Yum Brands because it gives us an example both to the short, long, and to the short side. Okay. Let me just find them quickly so I remember. Delete this stuff here. Okay. Let's look at Yum Brands. Very nice trend up into the beginning of the second quarter of last year, and it sort of looked toppy up here, and all of a sudden one day we came in on the 3rd of May. Boom, a big outside day, nasty, outside day. In fact, it engulfed the previous, whatever this is, 6 or 7 trading sessions or something like that. And we had follow through selling in the previous day, but in my book, you don't need that. Let me answer a couple of questions here. Do you have any risk reward targets? Phil, yeah, like I said, I try to go for somewhere at the very least between 3 and 5%. 5% is my sweet spot. At 5%, I either, depending on how the trade looks, take off the entire trade, or I take off a partial position. And defined risk. Okay, let me talk about defined risk. When I talk about any of these candlestick signals, this includes the hammer, this includes the engulfing. The day this candlestick showed up, I went short. Okay, my risk is limited by the top of this candlestick. In this case, the high of that trading day was 74.10. So whatever. So maybe I put it 10 cents above there or 20 cents above there, just not to get totally messed with. But if the stock goes above there, especially if it closes above there, I've been proven wrong. Okay, it's that simple. So this was not only an entry signal, it also automatically, without any emotions on my part, defined my risk. Okay, and that's very powerful. Rosa, the trade that got me in the candle that got me into risk is this one here. And Mark, yes, it'll be recorded and sent to everyone. This one here on the 3rd of May. Okay, let's look at a bullish example. Okay, because people tend to prefer trading the market from a long side, which I can understand emotionally. That's sometimes a little easier. And we had one, actually not that much after. We had one in July, on the 12th of July. We came into the support line again, by the way. It was a confluence zone, and we had actually a couple of buy signals, okay? We had first, after a downtrend, we came into and had a hammer. This hammer didn't quite work out so well yet, but we didn't fall below that, below the day intraday, okay? But the real signal came as a confirming signal of this hammer came here on the 12th of July when we had an outside day, fully engulfing the previous day, the 11th of July, okay? And then we were off to the races. Like I said, at the bottom, for going long, I always like to see confirmation. So to me, the real entry signal wouldn't have come until quite a bit higher, but nonetheless, it would have worked nicely going higher. And again, the stop would have been down here somewhere near 61, okay? Vaughn asks about where do you enter after the engulfing growth. So at the bottom of a trend, I want to wait for a confirmation day. I enter at the end of the day on the confirmation day. In this case, And again, the confirmation day does not have to come the immediately next day of the candlestick signal. It can come anywhere in the next 5 or 6 days or whatever, something like that. But once I see a confirmation buying, I enter at the market somewhere within about 15 minutes before the close. Okay. Doji is not one of my best indicators, Rick. No, there are just simply too many of them. Okay. I mean, look at how many there are. There's just tons of them all over the place. Okay, I have about 10 minutes left. I'm trying to be very quick here because I know we have another speaker coming. Let's move on to, so that's Yum Brands, that's the engulfing candle. And again, I need to see follow through buying, and it actually would be nice to see follow through selling before entering a trade at the bottom, at the top if you want to go short, although that's not necessarily a requirement. Let's look at the last one, the shooting star. Okay, the shooting star happens at the top of a trend and is, to me, hands down, as long as we've also reached a confluence on, also the highest probability signal I know, entirely. What happens at the shooting stars is it's a little bit, sort of looks like the hammer, except it's inverse and happens at the top. You have a long body and a long tail and a short body. Okay. Let's look at examples. It's always easy to look at examples. Look at Netflix. Yes, you can chart anything with candlesticks. Absolutely, that's the beauty of it. You can use candlesticks for many things. Let's look at Netflix shooting star. I guess it doesn't really matter. I can show you the one up here. Well, let's use this one here. Let's use this one here that happens, and it's a little bit more difficult to see just because I have this in here. But it happened on this, what is this, the 7th of February last year. Okay, so just about a year ago. The shooting star looks like this. I'm going to zoom in very close. Okay, the shooting star looks like it happens at the top of a trend. Okay, it has a small body and a long tail, a long wick. What does it tell me? It tells me essentially the opposite thing of what the hammer at the bottom does. The shooting star tells me we moved up and up and up and up, and all at some point buyers came in, but they couldn't hold the top. They couldn't any longer intraday push it. We had a nasty intraday sell-off, and again, this isn't the hugest shooting star I've ever seen, but it's a decent one, and we closed lower. The following day, we had follow-through selling. It wasn't huge, but we did have a gap down and follow-through selling, and there we were, off to the races, and of course, the stock ended up moving still a lot lower from the entry point came at about 124. The stock went as low as eventually 52, but I would have been happy with, like I said, between 5 and 10% of this stock. So that's the shooting star. Okay, it happens at the top of a trend, and in fact, there was actually one that had already happened here. So I probably would have taken this one here on the 30th of January 2012. I would have gotten stopped out. Actually, no, I wouldn't have gotten stopped out because the stop would have been at the very high of that day, and I think we may have gotten to that same high, but it didn't close above it. So I would not have gotten stopped out. And the next day, of course, we had another shooting star. So we had two shooting stars in the matter of a few trading days. So that's very powerful. And again, once I see a shooting star, I want to make sure I'm at a confluence zone of overbought levels. From a momentum perspective, I'd like to ideally have bumped into some sort of Fibonacci retracement level if possible, and also if possible into some moving averages that are showing me resistance. Some of the great trades happen at the very top of a trend. So Netflix, for example, in 2011, when it peaked here in July 2011, okay, we actually did have a shooting star. It just wasn't the greatest of all, but it was a shooting star, and we had a very nice follow-through selling day the following day. So that's Aaron. You're asking about credit push spreads. That's not necessarily something I cover here. That's probably something more for more of an options based strategy. I don't want to eat into other people's presentation. John's talking about necessarily rules of thumb about candlesticks, number of candlesticks before retesting. I'm not quite sure. At the end of the day, like I said before, if I see, if I go back to the example of F5 Networks, which again, it's a great trading stock. If I look into the stock where we had a confluence zone happening here in late or mid-September last year, we had a shooting star happening. We came into an important Fibonacci retracement. We had moving averages coming together. 200-day moving average actually served as resistance, and we did have confirmation selling coming in 3 days after the shooting star. If I see things like that, to me that's a blind trade. In this case, to the short side. Okay. Do you use morning and evening star patterns? Yes, I do. I just wanted to look at the highest probability ones here. Okay. Now I think that's more or less what I wanted to cover from my end. In terms of we are running a promotion on my swing trading product on MarketFi.com. What it looks like is this. This is the if you go to MarketFi.com and you can find my my product. It's called the Steady Trader. Trade Steady, Trade Wise, which is really, again, that's really what I focus on. I focus on high probability trades because I think anything else is just entertainment. We're in the business of making money. So if you focus on this, and by the way, this product is fairly new, hence there's not a whole lot of performance backdating yet. My performance as a money manager is, like I said, it's a little more than a dozen years, so that's not reflective of my longer term performance. That's simply because the product is very new. We haven't done a lot of trades yet. So that's kind of it. The promotion we're running is $5 for 1 month, and if you subscribe for that, we will also do I will do an exclusive webinar going through my swing trading strategy in extreme detail and really coaching you through it. And in this product, you get trade alerts every day of trades I do, analysis, morning videos. I research every stock that I have see confluence zones in, and things of that nature. So I think we have about just about 2 minutes and 45 seconds left. There's any other questions? Yeah, it was recorded. Yes. Do I share actual trades? Of course. I trade in real time in this product. It's I can't fake it. If I do a trade, it's in the system. It's real. It'll go into the performance of the portfolio. So that's really what the world is moving to. And I know Morgan and Kyle Bazzi over from MarketFi are going to talk about this later. Really, what I strongly believe in is the new reality of how investors should be treated, and it's with full transparency. With the stuff I do with my trading strategy, there's absolutely zero I can fake. It's all I trade. I analyze my stuff, and hence the stuff you get every day. And there you go. Do I use fibs in my confluence Fibonacci? Yeah, absolutely. It's a huge part in my analysis, and I will go through that in the special webinar for those
great. Thank you very much.
Advantage of the offer.
Thanks, Serge. We appreciate you being here.
I think that's all I have. I want
to
thank everyone for attending.
Somebody asked a question kind of about
also thank you, Morgan. Thanks so much
what the service is,
for
trading. We'll talk a little bit about
MarketFi
later. The last session is going to be myself and Kyle
great rest of
Bazzi from MarketFi talking about that. But it's kind of a cool thing if you're
thank you guys. Take care.
Been getting the TradingPub newsletter, you probably have seen some stuff about it basically. But the cool thing that they've done is they've got technology that tracks into Serge's account, so that whenever he makes a trade and sends out an alert, they know that it's an actual trade, an actual fill, that it's not like he's saying, buy Google at $50 and then, coming on and telling everybody they wish that, that he bought it at $50 on Friday when there was no chance, it's up much higher. So again, it's really cool, and basically what you get, the neat thing with it is today they're offering basically a $5 30-day trial at that link that you click, and it's a 30-day money-back guarantee. So I guess if you don't like it, then you can get your money back at the end of 30 days. So, but anyway, yeah, the link should work. If for some reason the link's not working, send me an email and I'll send it to you guys as well. So. Just real quick, want to update you again on the schedule. We've got some outstanding speakers coming up. We've got Frank Stanley with DTI. He's about to talk about income trading strategies. Yeah, Paul, that is for 30 days. Here's the link one more time. He's going to talk about income trading strategies, followed by Daryl Martin that's going to cover the ultimate hedge strategy. And then Tim Birkin is going to cover habits of wealthy traders, 20 habits of wealthy traders. And then Kyle Bazzi and myself will come on and talk about the evolution of traders. So yeah, very, very cool. I believe it's a month. So Paul, I believe it's like one calendar month. All right, Frank, you can come on and take it away. All right, yeah, our next speaker is Frank Stanley from DTI. Frank is the options instructor at DTI, one of the options instructors, and basically Frank has kind of a cool story. He started out like a lot of you guys that are here. He was a individual trader learning about the market, and he really, he started out in stocks and then really just kind of found his own in options, and so he does an outstanding job. I promise you this, that you guys will get a ton, and literally a ton, we measured it. You'll get a ton of education over the next 50 minutes. So, and then he'll be followed by Daryl, and then by Tim, and then Kyle and I will come on as the last session. So I see Frank's slides are loaded on the screen, and Frank, you can go ahead and take it away. I'll put a timer up there, and the room is yours.
How's the volume?